Could the markets face zero returns for the next decade? Sure, it certainly could. Is that something you should jump off a bridge? You go, oh my goodness. No, it's just anything could happen. But I'll tell you, there's hope. Hope springs eternal. Is that the way we say it? Anyway, let's read this. Not a bad article, actually, from Markets Insider. The stock market faces a lost decade of zero returns through 2031, according to this chief equity strategist. And they always show this guy. I hope he gets paid. Remember the NCAA has NIL now, name, image, and likeness, where these athletes can get paid, which is great. I hope this guy gets paid because every time let's see if he's on. Hold on, I'm gonna look at my app, my investing app, and we'll see if they show a picture of that. I see this guy probably more than I see my wife, actually. Let's see if they show a picture of this guy. Anytime they show markets being traded, they show a picture of that guy. Or yeah, right here. So you can see these guys right here. But they usually show that white-haired guy with a beard on a more often than not. Yeah, I don't see that guy. So at least they didn't do it today. Anyway, and look, he's got his glasses. Like, what? It's actually a good picture for clickbait. Like, what? Did I see it? What? What's the movie? Oh man, what's that movie? I remember, is it Marty McFly or something like that, where Biff, he took the glass off, he was like, what? Am I? Oh, what was that? Oh my goodness. I think it was the Saturday Night Live skit with Chris Farley when he's a man down by the river. You know what I'm saying? It's like, what, am I here? Oh my goodness. When he takes his glass off to look at David Spade, he goes, am I hearing what you said? Oh, it's freaking funny. That's what this guy looks like. He's like, what? They're saying 0% rates for return? All right, so let's read what my man says here. The next decade won't be as easy as the last one for investors in the U.S. markets. Instead of the S&P's annual compounded rate of return of more than 13% during the teens, investors should prepare for a likelihood of a lost decade or returns of 0% from the end of 2021 through the end of 2031. What might sound crazy to millions of investors that discover the stock market for the first time amid the COVID-19 pandemic. What? So we got to come back to that. Are they talking about the GameStop issue? Oh my goodness. Those aren't investors. Those are speculators. And we're conditioned to expect new highs after every sell-off. It's not out of the question about a 0% rate of return. You're conditioned after 2 years? That's just stupid. I hate that kind of dialogue, monologue stuff or writing. Like, oh, they've been conditioned. You've had 2 years, man. Yeah. In fact, it's already happened, with the stock market delivering a compounded annual rate of return of negative 0.9% during the aughts, 100%. So we have 13% during the teens, negative basically 1% during the aughts. If you combine the two, you get, what is that, 13? I don't even know what that is, but you can figure it out. We can even actually do the numbers. I just don't feel like doing it. But you can figure it out. So you take 13 every year, you times that by 10. And then you get 130. You subtract out the 0.9, right, from 10, and then you divide by 2. Whatever. We can figure it out. I just off the top of my head, I can't do it in my head. However, you're still well ahead from 2000 to 2021, even with the negative returns in the odds. All right. Over 2 centuries, 20-year returns to the markets have always been positive in both real and nominal returns. Real is net of inflation. That's really the only thing that matters. But over 10 years, you could lose money. I completely agree. U.S. large cap stock market index, real return, annualized growth with dividends reinvested and after inflation. So this is good. So I like this chart right here. And you'll see in 1850s, we had negatives. But right here, actually, I'm surprised in the latter part of look at that. Even the latter part of from 1870 to basically 1900, that's net of inflation. That's good. I mean, stocks kept up with inflation for those times. Right here was bad, ugly, but it's kept up with. Here's obviously the Great Depression right here and World War II right there. So we had a couple years, then we had the aughts. Not very likely a 10-year return net of inflation will be negative. Not very likely. Bannister's outlook for poor stock markets is driven by elevated valuation metrics, i.e., a lot of high PE ratios. It's frankly just not that elevated, man. It's not when you look at the the bonds, the corollary to bonds. I mean, you got to look at investing. I can invest in stocks, bonds, or real estate. Essentially, that's what the big three are. I know you can invest in crypto. I know you can invest in gold. You can invest in art. I'm just talking about the big three: stocks, bonds, real estate. So bonds are incredibly expensive relative to the yields you're getting. Real estate, I mean, I like real estate. I own my biggest asset is real estate, 100%. So the only other option, frankly, is cash and stocks. And I don't really have a whole lot of cash. I say I'm still got stocks. I'll share with you why this doesn't matter anyway. All right. As long as the, let's see, a local high in the percentage of stock ownership among households. So his outlook is negative because high valuations, and I get that. We've heard that for years and years and years. A high percentage of stock ownership among households. That's a negative. As well as potential for serious geopolitical risk. Well, there's always potential. Not sure why the high stock ownership among households. He's using the old if people are buying, that's when you should be selling, because basically the sheeple are buying and the sheeple are dumb. Essentially, that's the thing that we hear all the time. But a high percentage of stock ownership among households, that doesn't say anything. I mean, what's the percentage? 65% versus 63. I don't. It's just silly. Anyway, as long as the laws of supply and demand exist, we're going to have supply chain disruptions, geopolitical rivalries, indebted governments, populism, all right, whatever, and profit margin, regulatory pressure. I'm actually going to do another video later why the laws of supply and demand exist, and how I think that's actually helpful to stocks. I'll share with you why here in another video I do. Some of this has already started to play out in 2022. All right. I like how they say the invasion has led to at least they're saying exasperation as opposed to led to supply chain disruptions. It has led to exasperation. Exasperation. Yeah. Seems like they're not saying it right the way it's spelled. A massive price in everything from wheat to oil to nickel. That is a concern, big time. I would say that locking up Russian reserves was a big watershed moment is when Nixon, that's got the U.S. off the gold standard. Whoa. Yeah, man, that's a good point. This told the world they need to find alternative reserve currencies for the assets. Yeah, that is an interesting take. I missed that when I first reviewed this. Locking up Russian reserves was as big as a watershed moment as when Nixon got the U.S. off the gold standard. Huh. Now they're saying the Chinese yuan could rise at the expense of U.S. dollar. I'm not all that worried about the yuan, but they're going to create an alternative currency, the BRICS, and that's it is what. There's nothing you can do about it, my friend. So worrying about it doesn't make sense. Geopolitical tensions could get even worse if China invades Taiwan, and he says Xi Jinping is not going to die without making a try at Taiwan. We don't know that. I mean, maybe. How can investors eke out positive returns? Simply buying and holding the S&P 500, a strategy has done remarkably well since 2009, is not the answer. Jeez, man. Buy and hold is the ideal strategy in the bull phases, but the down phases, being in the index, is not going to generate a positive return. Investors who are passive are going to suffer. Instead, investors should allocate to real and alternative investments. And let me guess, he's got to have, does he have crypto? No, but he says long, short stock picking strategies often employed by hedge funds. And of course, this guy is paid by investment firms who don't want you to be in an index fund. Where is the proof, Bannister, that active management stops the downside? Where's the proof? Yeah, you got some Swan, the derivatives, I get it. Buy and hold options, 100%. The vast majority of active managers don't do any better in down markets than what you just. There are some. There's also some active managers who have done better in up markets. To say we're going to say because Swan, I like Swan. That's the. They buy puts. I can't remember. They do options to limit the downside risk. I got no qualm with that. And it did fantastic in 2000, the odds. So did Craig Israelson's 712 portfolio, 100%, with a hell of a lot less fees too, 100%. But to say active management will mitigate the downside, it's just, I have heard this my whole career, and I've yet to see evidence of that. None whatsoever. being in the index. Okay, investors are passive. Going to investors should allocate to real and alternative investments, commodities, real estate, and the more active long short stock picking strategies that people like this guy use and get paid for. Value stocks should outperform growth stocks. I completely agree with that. All right, so anyway, there you go. I don't care about this right here, and I think that's pretty much it in the article. I just find it funny that they still active managers push active management. Shocking. Let me show you something though. For the S&P 500, we're just going to go to 2000. We're going to start in 2000, and we're going to invest right there, $5,000 a year. All right, so we're going to go to 2000 to 2009, 2009er, and we're going to invest $5,000. We're going to have $10,000, and we're going to contribute fixed amount $5,000 a year. Yep, and we're going to adjust for inflation. Oh, sweet, I can do monthly. Let's do $2,500, $250 a month. There you go. I'm not even sure what that equals, but yeah, let's say $500 a month. $250 for you and $250 for your employer in a 401k. All right, and we're going to do it all in the VFINX. All right, S&P 500. We're going to put it right there, 100%. And we're going to come down here. Remember, we start with 10,000 schmackes. We're putting $500 a month in. That's $6,000 a year. You're doing $250. Your employer's doing $250. I'm just pulling this out of the air, my friends. And we're going to see what our portfolio did after 10 years. All right, so oh my goodness, 10,000 grew to even here the worst case. Let's just make sure. Yeah, there you go. To 48,000. I'm doing $500 a month contribution frequency. Yeah, there you go. 10,000, $500 a month. Yeah, there you go. Just want to make sure I'm not. Oh, good. So, I mean, you still made money. Did you make a hell of a lot of money? No, but you still made money. You averaged. You lost 1% a year in terms of your trailing returns, but you still are well above where you were. In fact, by the end of 2009, you had $82,000 there. Oh, right here. Compounding annual growth rate 23%, and so you'd have to inflation adjusted. I think this right here is the. I can't remember what this one is. Anyway, but you can see it right there. So we had total returns, annualized returns. I can't remember if this is adjusted for inflation. Look, full -1%. Our best year is 26%. I think compounded annual growth rate is what you made from point A to point B of memory serves. You can look it up. I don't care. All I'm saying is at the end of the day, we put 10,000 in. We're investing $500 a month, and by 10 years later, we're at $82,000. We had 8 times what we started with because we actively invested. We actively put money in. That's all that matters. Now, if you're retired, on the other hand, well, you don't want to do that because, well, you're not going to be actively putting money in. You're going to be withdrawing money instead. So let's take $500 a year. There we go. Actually, before I do that, let's go to dividends. Let's not do dividend reinvestment. Now, only 10 years, it probably won't change much, to be honest with you guys. Okay. Dividends must be reinvested when cash flows are present for the portfolio based on. Okay, so I guess they're making us reinvest the dividends. I wonder why. Well, let's just do. All right, we'll start with. We're not going to put anything in. We're going to do no dividends reinvested. All right, here we go. I think. What does it tell me? Also, let's pause it real quick. All right, here we go. So we're putting $10,000 in. We're not doing any cash flows. We're not reinvesting the dividends, and we're going to hit analyze portfolio. And what you're going to see is that we started with $10,000. We had $7,500 by the end of the decade. So we lost right there, compounded annual growth rate. I don't get what the other one said, 27. I'm not sure what that. That's negative 2.72, which is exactly right. And I'm not sure why I said. I'm confused by that. But anyway, so we lost money. We lost almost 3% a year because we didn't reinvest dividends. If we did reinvest dividends, that's why you got to buy some with dividends, because dividends, I'm telling you, are critical, man. Critical in inflationary and particularly in deflationary markets. If you reinvest in dividends, we're at $9,000. So while we lost almost 3% without reinvesting dividends, we only lost 1% with reinvesting dividends. still confused. Like, let's just go to cash flow, contribute fixed amount, contribute contribution. Let's just do $6,000 a year then, just make it simple. So we're putting, yeah, I guess it makes sense. We're putting $60,000 in over the, yeah, there you go. We're putting $60,000 in on top of a $10,000 investment. Yeah, I don't get why I said compound annual growth rate is 26%. That doesn't make sense to me. So something, yeah, right there, it's not 23.4%. Yeah, I don't get that, man. So here again, we're at 81,000. So yeah, when we have a cost basis essentially of 70, we made $10,000 on the money, but we made money. You know, that's how you make money in a zero return market, just by contributing. Now, if you're in a retirement phase, you're not going to be contributing. So you doggone better have some cash just to protect yourself. All right. Love your thoughts. We'll see you